Let's talk to Ben Kumar. He's an investment manager at Seven Investment Management. Very good morning to you, Ben.
Good morning.
Right, you've got 6 minutes to have a rant on your soapbox. So let's kick off with 10-year money, 3%, okay? Hitting the headlines, VIX rallied last night over 10%. Is this sinister?
It's been close to 3% for so long now that I find it kind of bizarre that anyone hasn't been taking it into account. Right? Everyone talks about when bond yields rise, equities get less valuable because your discount rate's less or whatever, or it's just you don't want the dividend quite so much because you can buy a bond. Well, bond yields have been at about 2.8% for the last 3 months. 3% is not that much higher. It doesn't affect your equity valuation in that meaningful a way. It shouldn't really affect your preference for dividends. I don't think it's the big event everyone's claiming that it is. Also, the Federal Reserve's been telling us for the past, 2-3 years, that rates are going to rise. This is whatever the opposite of a surprise is, this is it.
Right. Okay, so Mr. Carney, tell me about obviously, we were all looking for a May hike, and it doesn't look like it may or it may not happen.
If I were Mr. Carney, I'd take a leaf out of the Federal Reserve's book, and that is kind of proceed with what the market expects and then get your communication right for next time. So I would not be rowing. He does things in a slightly odd fashion where the message changes a bit more often than it does. Now, I'm of the school of thought that if you are going to do communication as a central banker, you should communicate quite clearly what's going to happen, and that's fine. Or do it like Japan, where you don't say anything and then just raise rates or change your interest discount overnight. That's fine as well, but the kind of surprise communication just really defeats the point of forward guidance altogether. I think we'll have 2 interest rate rises in the UK this year.
Okay, so cast inside sort of the Bank of England's pitch on this, okay, can the UK economy take 2 rate rises this year?
Yeah, the UK economy is fine, if not better than fine, right? A global growth environment is the best thing for the UK economy. Yes, we've got some problems in the future. Yes, there's some trade deals we need to sort out with our biggest partner. But for now, trade with Europe is open. Europe's growing at the fastest rate we've seen in about a decade.
Yep.
What are we worrying about? Get interest rates back to normal as soon as possible. Now, yeah, there might be a little bit of a slowdown in the UK economy, but unemployment's not going to suddenly shoot up. You know, people are not going to suddenly start going bankrupt. You're not going to have 2007, 2008 again, because it will be a gradual increase. I think the UK can deal with rates at slightly more than 0.5%.
Okay. In terms of the stock markets, okay, do you think we made the highs for the year? Do you think, we're going to rally like a homesick angel? Because it's suddenly, for the last few weeks, gone super bullish again.
Yeah, I think we will make new highs this year, but I think, particularly in the US, it's going to be driven by stocks that aren't the tech stocks. Right? Look at investment bank earnings, or just bank earnings in the UK, in Europe, in the US. Like, banks are finally making money again because they've stopped paying massive fines for LIBOR, stopped paying fines for the crisis, stopped paying PPI insurance here in the UK. Banks are making money and they're starting to lend. That's good for the economy sectors as well. It's all pretty good news. Caterpillar came out with results and said, we think Q1 might be the highest we get this year. Their Q1 was staggering, right? It's really, really impressive how far most companies have beaten earnings expectations. The market should rally.
How much of that is down to the tax change?
Yeah, everyone says, it's only down to the tax change. Fine, but that's a real impact. If I say, all right, Moose, here's a free handout, here's £50. You can say, well, I shouldn't take into account that happening every time.
But it's still £50.
Still 50 quid that you've got to go and spend, right? Yeah. So, it is down to the tax change, but companies will make more money on the back of it, and that's what drives stock markets higher. I can see this rally continuing, a bit more volatile, difference in sectors. You don't just buy the tech stocks and hope. Active managers have been crowing for years that they're waiting until there's more dispersion in the markets. Yep. We'll see who's good now, see who can pick stocks when actually stocks do different things. But, I think there's still a lot of money to be invested in this market. The bulls got some way to go in my eyes.
On that note, young Ben, that all sounds very, very upbeat to me. That's Ben Kumar from Seven Investment Management. Thank you very much.